Did you know there are several ways you can access your retirement account before age 59 and a half without paying the 10% early withdrawal penalties? In today's episode, we'll walk through 7 options that allow early access to your retirement savings and why you might consider using these, especially if you're navigating a transition, supporting a loved one, maybe just need a little bit more flexibility. Welcome to another episode of the Simply Retirement Podcast, where we want to educate and empower women to live your retirement on your terms. I'm your host, Eric Blake. If you're a woman nearing retirement, or maybe you're already in retirement, you've probably heard the warning that you don't want to touch your retirement accounts before the age of 59 and a half, or you could be paying a 10% early withdrawal penalty. But the truth is, life doesn't always happen following the IRS's timeline. So whether you're facing early retirement, you're dealing with a health event, maybe you're trying to support a family member with housing or education costs, you might have more flexibility than you actually think. Before we get into today's topic, let me introduce Wendy McConnell. Wendy, how are you?
I'm good. How are you?
Excellent. It sounds like another fun topic. I know how much you love taxes and all these fun things. So
hey, I love money. So
there you go. That's a good start. That's always a good start. So this episode was actually inspired by the conversation I had with Shalonda Wagner. She was a guest on episode 39. And hopefully we've got some people that might remember that conversation. But Shalonda is the founder of Ladder House Decor. And she works with women that are leaving abusive relationships and helping them furnish their new homes when they're trying to start over. And she shared that one of the most difficult obstacles that many of these women face is not having access to financial resources. Even in some cases, of course, financial abuse being part of those situations. And during our International Women's Day event, I actually shared a strategy, and this is what made me think about this topic, that in Secure Act 2.0, which was voted into law a few years ago now, there is actually a provision that allows survivors of domestic violence to access up to $10,000 from their retirement account without the 10% penalty. And I actually shared some of the specifics on that. And it's one of several little known strategies that actually can make a huge difference in someone's financial freedom, especially if in that situation where I don't know where to go to, and they feel stuck because they don't have access to financial resources. So this conversation, it just reminded me that, there are women that don't understand some of what's available to them, and, people in general, but especially if you're, again, being in a difficult situation. So today I wanted to walk through these 7 options. I wanted to share a couple of strategies that go along with the options just to help people understand how and when early access to your retirement accounts might be possible without that 10% penalty.
All right, let's do it.
Sound like fun?
Yeah.
Awesome. Well, of course, always got to get these disclaimers in there, especially when we're talking about taxes. I always got to get that in. So always make sure you talk to your financial advisor, talk to your tax advisor before implementing any of these strategies, because early withdrawals definitely can impact your retirement income, your tax situation, and even your long-term financial security. And also, I want to say that just because you can do these strategies, because you have these options available, does not mean you should.
Right.
So again, talk to your financial advisor, talk to your tax advisor, make sure you know all the ins and outs before you actually utilize one of these options that are available. So the first one we're going to talk about is what's called the Rule of 55. And that is, if you separate from service from your employer after turning age 55, you can actually access or withdraw money from that 401k plan without the 10% penalty.
Okay.
Now, the big thing is this only applies to 401ks. This is not IRA accounts. So you got to be sure you're aware of that.
So it's connected to the work.
Yeah, so it has to be an employer plan. A 401k could be, there's some other employer sponsored type plans that could fit as well, but it is not IRA accounts. That's the big no-no there. Okay. This does not apply to IRA accounts. Important caveat here as well, and they talked about this back on episode 48 with the mandatory 20% withdrawal penalties if you do take money from the employer plan. So go back and listen to that episode as I go all through the details of how that actually works. So yes, you can access the money from the 401k plan after 55, no penalty, but just be aware there's a mandatory 20% withholding for taxes if you take that money out.
Okay.
Now, this is also, for some people, this is a reason, I hate to throw financial advisors under the bus, but sometimes it's appropriate. But this is also a reason why you might want to think about not rolling that 401k to an IRA. So again, I said it doesn't apply to IRAs. This doesn't work for IRA accounts. So this might be a circumstance where you say, hey, even if it's just temporarily, let me leave it in the 401k in case I need some liquidity. I need access to that money rather than rolling that money into an IRA.
Okay. I got it.
Then we have what are called substantially equal periodic payments, right? And let's shorten that down to SEPP, or the tax code, which I'm the tax nerd that knows this,
right,
called 72T. What this does is it basically says, okay, I'm going to tell Uncle Sam I am willing to take out a certain amount every single year in order to avoid that penalty. Now, the rules are that you have to set up an equal periodic plan. That's where that name comes from. Equal payments over at least a 5-year period or 59 and a half, whichever is longer, right? So if you're 52 and you want to implement this strategy, you got to take out money for at least the next 7+ years until you turn 59 and a half. That's what it's telling Uncle Sam. I'm going to be taking money out every single year. I'm going to take the same amount out every year. Uncle Sam will waive the 10% penalty, but it is still taxable. If you're 56, now it becomes 5 years. So you have to go past that 59 and a half age. So you got to take it out at least the same amount for the next 5 years in order to have that 10% early withdrawal penalty waived.
Okay.
All that makes sense?
Yeah. So let me just clarify. I lost a job 5 years ago.
Mm-hmm.
I've left it in that company's 401k program. If I need to access it now, does that mean that I can, according to the rules and stipulations you just put forward?
No, so that's the tricky part. So the separation of service has to happen after age 55 for that first rule. So the rule of 55 means you have to have separated from service after 55.
Gotcha.
Doesn't mean you can access the money after 55. It's the separation of service that's the key. So in that situation, if we go look at this next strategy, number 2, the 72T or the SEPP, that's where you say, okay, well, I'm not 55 yet. I've separated from service, but I still need access to funds. Maybe you then think about a strategy like this that, again, I'm going to tell Uncle Sam, I'm going to take out X amount based on different form. There's some different formulas. Again, consult your tax advisor on what those options are, to consult your financial advisor. But it basically saying I'm going to take out X amount every single year for the next 5 years at a minimum, or 59 and a half, whichever of those is longer.
Okay. Got it.
So here's kind of a planning tip along with that one, though, is if you happen to have, there's a lot of people out there that might have multiple IRA accounts out there. They they retired from one job and they rolled that to an IRA, then they left another job and rolled that to a different IRA. And rather than consolidate them, maybe they have different IRA accounts out there. One of the things you could potentially do is say, okay, I'm only going to turn that 72T on, that mandatory distribution, from one of those IRAs, right? That means the other one stays alone. You potentially, if you had in some unexpected emergency, you might be able to access additional funds from that. But the problem with this strategy is that if you ever stray away from the plan, you ever say, okay, I'm going to take X amount out for the next 5 years, and you take more than that out, or you take less than that out, that could basically trigger back taxes and back penalties on all the money that you took out previously. So that's where, again, understanding those options and understanding how all this works is really critical.
Okay.
Number 3 is going to be Roth IRA contributions. So one of the reasons why I almost always recommend contributing to a Roth IRA if you meet the income limitations, the income requirements, is because the money that you put into a Roth IRA as a contribution, you can take out at any time, no taxes, no penalties, no nothing. Now that's your contribution. What you've put into it, doesn't matter when you put into it, what age you put into it, you can take out your contributions, no penalty, no taxes.
Ever, no matter what the age is.
The contributions, yes. So if you're 25 years old, that's why, especially like younger clients that say, hey, I want to start saving money. Students, my son, people like that, where they're just trying to get started. Roth IRAs are such a great vehicle in order to begin savings, because at that age, life happens. It just does. Unexpected things happen all the time. So I said, okay, I put this year the contribution limit is $7,000 for a Roth IRA in 2025. Well, so I put that's if I'm under 50 years old. So I put $7,000 in, and next year all of a sudden something just comes out of nowhere. I need access to money. I could get my $7,000 out with no taxes and no penalties.
Okay. But you can't take out, say, any interest.
The earnings. So if I put $7,000 in, and by all things work out great, and next year it's worth 10, I can still take my 7, but I got to leave the 3 in.
Well, you are optimistic. I was going to say 7,500, but hey, we'll go with your scenario.
That's right. I like mine better. And that's where the tricky parts, though. So you and now some of these other rules we're going to talk about, that's where the $3,000 in earning could potentially be accessible, avoiding that 10% penalty with some of these other strategies we're talking about. But really the key is the ability to get those contributions out if something unexpected happens. And that's where a Roth IRA is something that people will remember the term rather than the actual full name of this, but it's called FIFO. So first in, first out. So the first money that goes into the Roth IRA account is the first that also comes out. So that's why anytime you put money into a Roth, if you take a distribution, the first thing that Uncle Sam says, okay, when you take money out, your contributions come out first, then the earnings later, if you happen to take out more than what you've put into it.
Okay. You mentioned that the maximum to contribute to a Roth is $7,000 per year for those under 50. What is the maximum for those over 50?
Great question. So if you're over 50, you have the additional $1,000 catch up for 2025.
That's it.
You can put up to $8,000. Yes, $8,000 into your Roth IRA account. Now, if you happen to have access to Roth 401ks, you're going to have a higher limit. But as far as just the IRA itself, that's what the limit is for 2025.
Not that I have the $8,000. I just wanted to maybe.
Oh, you can find it somewhere.
Oh, absolutely. Yeah. All right.
Yeah, you got to have somewhere laying around.
Yeah.
Check the cushions of the couches.
There's some coins in there, I'm sure.
That's right. I'm sure that'll add up to 6,000 or 7,000, 8,000 maybe.
Right.
Then we have in this might be a circumstance where you're a young achiever, you're trying to build yourself up, but you say, hey, I'm ready to buy a house. You have the first time home purchase, and again, talking about IRAs versus 401ks, this is IRA only. So you can only do this with an IRA, but you can withdraw up to $10,000 penalty free from an IRA to buy your first home. Now, one of the tricky things, and why, again, I don't know who comes up with these rules, but you're considered a first-time home buyer if you haven't owned a home in the past 2 years.
Oh, what?
Right? So, again, it's one of those things that, who came up with this? Who sat down and say, let me throw this curveball in there.
Yeah. Well, it's actually good for us. So. Yeah. Right.
Yeah. And again, but it is, again, to make it even more convenient, it is a one-time, lifetime only thing. So it's not like you can, I use the $10,000 this year, I sell my house, and 5 years later, I'm ready to buy another house. I can take the other 10, I can take another 10. Doesn't work like that either.
Okay.
So it's just a one-time only, first-time home buyer. But, there are those circumstances where, I was in a house, I had sold it, downsized, whatever it might be. I stay in an apartment for a couple of years, and then I buy another house. If you've never used this before, that would still be a situation where you would qualify as a first-time home buyer for this purpose.
I have to tell you, Eric, I wish I would have known this. Is this a new rule? Because I actually had to cash out some retirement savings to purchase the house.
You didn't know me. If you had known me, that wouldn't have happened.
All right, hindsight. There we go.
But it is, again, I'm not to keep hammering this point, but it is one of those circumstances where the financial advisor you work with does make a difference in terms of whether they understand these rules or know that these options are out there.
Don't make my mistake.
Yes, learn from your mistakes. That's the key to success, is learning from others' mistakes, right?
Yeah.
Then we get to higher education expenses. So if you're using money to help pay for education expenses, tuition, books, qualified expenses for yourself or family members, same scenario. You can use those dollars and avoid the 10% penalty. Again, you still pay taxes, but you can use those dollars for education. And again, does not apply to 401ks. This is only IRAs as well. So I'm trying to make sure we distinguish on these, which ones apply to IRAs and 401ks or potentially both.
Okay.
All right. Then we get to one of the more challenging ones, but one of those things that definitely comes into, can definitely be valuable, permanent disability. So if you're permanently and totally disabled, you can use retirement account funds without the penalty. Now, this is one that does require a physician certification, and it must meet pretty strict IRS criteria for that to be accessible.
Mm-hmm. So you're probably going to be in for a fight when you go.
It is. So it's very along the lines. If you think about qualifying for Social Security disability, it's going to be very similar to the definition of disabled, whether you're talking about Social Security disability or you're talking about being able to access funds with no penalty. Yeah,
because they make it difficult. They don't want you to do this, so they're going to make it hard for you.
Right. Exactly. Then we get to unreimbursed medical expenses. Again, another one of those things, where you hate to go through these circumstances, but they do happen. Life just happens sometimes. So, and this is a case where you can withdraw from IRAs or 401ks, penalty free. Again, it's always going to be taxable to cover medical expenses, but there's that hurdle. So if people have itemized their taxes, or maybe because with a lot of with the Tax Cuts and Jobs Act that we fall under currently, a lot of people aren't able to itemize because the standard deduction is so high. But if you have enough property taxes or mortgage interest and things like that, you have this 7.5% hurdle that allows you to itemize those medical deductions as well. Well, this is a situation where that same threshold could potentially allow you to use IRA dollars and 401k dollars, retirement account dollars, to pay for those medical expenses that surpass that 7.5% hurdle.
Okay.
Right?
Got it.
So again, same thing, avoids the 10% penalty.
What are you doing there, Eric? My goodness.
Know, I keep banging this. I can't. I don't know. I don't move my right hand. I only move my left hand. I don't know what's going on.
I can only talk with my left hand. Your back.
I guess I need to. We'll see. Nobody can. Only people on YouTube can see this right now. So.
Well, everybody heard that.
I know. I just woke everybody up in case you fell asleep while I was explaining the.
Bong.
You're awake now.
Here we go.
We're just in time for the strategies that go behind some of these. So you woke up just in time.
Good.
So one of the things I wanted to point out back to the domestic abuse exception is part of the Secure Act 2.0. So number one, it does apply to IRAs and 401ks. The other thing, and this is really something that, you think about someone, a woman coming out of one of these unfortunate situations. When I talked about the disability exception, it has to be certified by a doctor. This exception is self-certification. That means you don't have to tell a soul that you are doing this.
Okay.
So if you're in a situation where, hey, I can't get out of the situation, I don't have access to money, I can't get to the bank account, I can't get to these accounts, this is strictly self-certification. So if you happen to have an IRA and you're in one of these unfortunate situations, this is self-certified. You don't have to tell a doctor, you don't have to tell the police, you don't have to tell anybody. The only trick is it quote unquote technically has to happen within 12 months of the violence event. Now
okay,
go ahead. I thought you might have some clarifications on this.
So you don't have to prove that you're a victim of domestic violence. Is that what you're saying?
Basically, yes. So it's one of those that basically, and it doesn't say, and then certainly this is all based on the IRS guidelines here. So again, consult your tax advisor. But there's nothing specific around, is it physical abuse? Is it verbal abuse, emotional abuse? There is no specific clarifications as to what type of abuse it is either. So that's really one of those things. Again, are there going to be potentially people to take advantage of it? Yeah. But, for our purposes, it's just saying, hey, we know there are people out there that they're dealing with this. They don't know where to turn. They don't feel like they can get out of the situation a lot of times because of money, not having access to money. But in this situation, this is where you say, okay, I've got access to these retirement account dollars, and this is a way to potentially get yourself out of that situation.
So you mentioned that the only stipulation is 12 months from the incident. How do we determine when the incident was?
It's self-certification. It's basically it's
gotcha.
Honor system. It's really the only way you can really explain it.
Yeah. I'm in favor of that.
Now, here's the other thing that is different from some of these other strategies and options that we talked about. You actually have the ability to repay that amount within 3 years of receiving the funds and eliminate the taxes on that.
Okay.
So just kind of walking through what that might look like. Say you take it out, I take $10,000 out on January 1 because I'm trying to get in a better situation because of abuse. This then says, okay, over the next 3 years, I can pay that money back, pay that $10,000 back, and eliminate the taxes that I would owe. So again, it avoids the penalty already. It is taxed. It's a taxable event, but if you pay that money back within 3 years, you basically have to file an amended return, but you can get a refund of those taxes if you're able to accomplish that. Again, not everybody's able to, but it is something that to be aware of. If you can pay that $10,000 back, you can actually get a refund on the taxes that you paid.
Okay, you just answered my question. I was going to say, does that mean that it's not taxed when you take it out, but it is, right, but then you can get it back?
Right. You have to file an amended return. So if you, let's say January 2026, you take $10,000 out, and by 2027, you can pay it back. You then say, okay, I would file an amended return in 2026 or 2027, depending on, again, how everything fell, in order to get a refund of those taxes paid. But you are going to get what's called a 1099-R. It's going to be I did it again, 1099-R, that indicates that it is a premature distribution if you're under 59 and a half. You put it on your tax return just like you would any other type of distribution. But then if you can pay it back, you amend that return in order to get a refund of those taxes paid.
Okay. Gotcha.
Right. Let's see. So again, it's just one of those things that a lot of people don't know about. And we just want to make sure we spread this type of knowledge that if it's again, one of those difficult situations where there's been abuse, that, hey, this is a possible way of accessing financial resources when you might otherwise not realize that it's available.
Mm-hmm. I like this option a lot.
Then we get when to touch on this. So a lot of these things, of course, we're talking about how do we avoid the penalty. In pretty much every circumstance, it is still taxable. You want to be aware of that. But then I want to bring in what's called the 60-day rollover rule, or also maybe called, you might hear the term indirect rollover, which means if I said, hey, I took out an amount out of my IRA account for whatever reason, one of these reasons, or something, some other, whatever reason it might be, that didn't apply, this didn't apply, and I just decided to take money out. If you can redeposit those dollars back into an IRA, a lot of times it's going to be the same IRA you took it out of, but it doesn't necessarily have to be. If you deposit that money within 60 days of taking it out, then it's not taxable. It's not a taxable event.
Okay? I knew that one.
You've had experience with that, or you just aware of it?
No, I just knew that one.
Good. So, but again, it is important to know because you might be, unfortunately, a lot of times you take money out of an IRA, it's in response to an emergency situation, or I didn't have any other access. I didn't have enough cash reserve or savings in order to cover whatever I needed to cover. But all of a sudden, my situation changed, or I came into money, whatever it might be. If you can redeposit those funds within that 60-day window, then you avoid the taxes on that.
Or, it could be a situation where you're leaving your job, you take out the 401k funds, have them, written out to you, and then you have 60 days to redeposit it somewhere else.
Right. And that's a very good distinguishment between a direct rollover, which is where I'm taking the money out of my employer's plan and I'm rolling it directly to an IRA provider, where it's basically the check is cut to the IRA provider for your benefit, but it's not cut to you. That's definitely a key point to be aware of. Now, the other thing to be aware of here is you can only do this once in any 12-month period.
Okay.
So that's what some people get confused by or get caught by as well is, I did it once. So something else, an unfortunate event or an emergency comes up 6 months later, you can only do this one time within any 12-month period.
Okay.
And even if it's missed by 1 day, that withdrawal becomes fully taxable and potentially penalized depending on why you took it out.
There is no grace period here, people. You do not want to be late on this one.
Not at all. Not at all. Now, it doesn't apply to inherited IRAs, and it does not apply to RMDs, required minimum distributions either. So that's, again, just a couple of other key points. So I think we hit everything there. And then I want to touch on this one last strategy, inherited IRAs. So we talked about this in episode 52. Inherited IRAs are always penalty free. Doesn't matter what age you are. So if you are the beneficiary of an inherited IRA, you can take money out at any point, any age, with no penalty. Again, it's still taxable, assuming it's a traditional account, still taxable, but you avoid those penalties. So if you happen to be in a situation where maybe you have both, you have an IRA in your own name, and then you have an inherited IRA that you receive from somebody else, you typically would say, if I did have an emergency come up, then I would want to take that money from the inherited IRA so I know I avoid the penalty in that circumstance.
Okay. That sounds like the best plan.
So definitely go back and check episode 52 where we talk about 10-year rules for non-spousal beneficiaries and things like that. So you still need to understand the rules related to inherited IRAs, but that's a big difference between inherited accounts and an account in your own name, is that inherited IRA accounts will avoid the 10% penalty regardless of what the age circumstances might be.
Okay.
So as we kind of get ready to wrap up, so, obviously these financial strategies, they're not just financial tools, but in certain cases they can be, lifelines during difficult transitions, hardships, opportunities that might come around. But again, it's just knowing what's available to give you the confidence to make better decisions and avoid some of these penalties. So Wendy, just before we wrap up, is there any other thoughts or questions that you have about any of these strategies? Maybe anything that in particular stood out to you? I know you referenced the domestic violence option as we were talking, but anything else that jumps out?
Just again, the mistake that I made, had I known about the, being penalty free to take out money for a home purchase, even though you needed to not have owned a home in the last 2 years, which is iffy now. I can't think that fast math wise, but yeah, I mean, it's definitely something to take advantage of because I paid the 10% penalty.
Yeah.
Yeah.
And again, it's not, nobody likes to pay taxes, but then when you throw that 10% penalty on top of it, it makes it even that much, like that's just the extra icing on the Uncle Sam cake.
Right. And nobody wants the Uncle Sam
That's
cake.
right. Not at all. Not at all.
It's worse than fruitcake.
Yeah, that's not even close. It's not. I'd much rather have the fruitcake over the holidays than the Uncle Sam's cake.
Exactly.
So, well, excellent. Well, if you're unsure of which strategies may apply to you in your situation, or if you want help building a retirement plan that is tailored to your goals, we obviously want to be here as a resource. If you'd like to take advantage of our free retirement assessment through the Simply Retirement Roadmap process, it's designed to do exactly that, to help you evaluate your income, your investments, your tax planning strategies, so you can navigate retirement with confidence. If you'd like to, you can visit www.getmysimplyretirementroadmap.com to review our process. You can even schedule your 20-minute get-to-know-you call right there. That is it for today's episode. For all the links and resources, we're going to be sharing a lot of these links that we've talked about today. You can go to www.thesimply.retirementpodcast.com. Please don't forget to like, follow, and share our show. Until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
That's it for today's episode of the Simply Retirement Podcast. We hope you found our insights and advice helpful in planning for a fulfilling retirement. Don't forget to take action on what you've learned today. Visit our website at blakewealthmanagement.com to learn more about our firm and review our Simply Retirement Roadmap process to get you on the right path to the retirement you deserve. And don't forget to click the follow button to be notified when new episodes become available. Thank you for joining us on this journey, and we look forward to helping you achieve your retirement goals. Remember, retirement is not the end of the road. It is the start of a new journey. So embrace it and make the most of it. Until next time, take care. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor, Blake Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.